Welcome to The Explainer. Today, we're unpacking a massive corporate transformation and the highly anticipated Q1 2026 financial revival of DSM-Firmenich. If you follow the markets, you know this Swiss-Dutch giant has been incredibly busy redefining its entire identity. Well, the latest data is in, and it shows that this massive pivot is finally bearing fruit.
So it begs a fundamental question. How exactly does a 150-year-old legacy giant successfully pivot away from a broad, historically heavy portfolio, one that included things like animal nutrition, and transform into a hyper-focused consumer health, taste, and beauty powerhouse? You know, it's not an easy maneuver. It takes shedding a ton of legacy weight, redirecting capital, and ultimately proving to the market that this new, leaner machine can actually generate superior growth.
To make sense of it all, we're going to break things down into three core pillars today. First, we'll look at the strategic transformation, then the Q1 2026 financial highlights, and finally, how they're rewarding their shareholders.
All right, let's dive straight into part one, the strategic transformation, or as I like to think of it, trimming the fat.
The absolute turning point for them was a colossal €2.2 billion divestment. They sold off their animal nutrition and health business to CVC Capital Partners. Now, this wasn't just your run-of-the-mill asset sale. This was a definitive line in the sand. It officially marked their exit from that entire sector so they could focus purely on higher-margin consumer goods.
This shift took them from a heavy, legacy four-segment model straight into a streamlined, pure-play consumer company. Today, they're focused exclusively on just three segments: perfumery and beauty, taste, texture, and health nutrition, and care. Basically, they trim the fat, leaving only the specialized, high-margin muscle.
Which brings us right to part two, the Q1 2026 financial highlights. It's time to smell the roses.
To really appreciate their current momentum, we have to look back at the official 2025 financial figures for a little context. Back in the second half of 2025, they were facing a really challenging macroeconomic environment: cautious consumer demand, adverse foreign exchange effects, you name it. So going into Q1 of 2026, the pressure was absolutely on to show a strong turnaround for their continuing operations.
And they delivered. Their Q1 2026 like-for-like sales growth hit 4%. That is a seriously solid start to the year. But here is the absolutely crucial takeaway. That 4% growth was entirely volume-driven. They weren't just hiking up prices to mask weak demand. They actually moved 4% more volume of their products. That's real, tangible traction. When we break down the individual segments, we can see exactly where that momentum lives. There's a really solid contribution across the board for their newly defined continuing operations. Taste, texture, and health came in at 2%. Health, nutrition, and care hit 4%. This essentially proves that their core consumer focus is stabilizing and even growing, despite those lingering global economic headwinds we talked about.
But the standout star here, without a doubt, is the perfumery and beauty division. They surged with an 8% like-for-like volume growth. That vastly outpaces the overall company average. It just goes to show that creating scents for consumer brands and fine fragrances is a highly resilient business, especially considering it's operating with an adjusted EBITDA margin of 22%.
Okay, let's move on to our third pillar, rewarding the shareholders, and specifically their capital allocation strategy.
For starters, right on the heels of completing a massive €1 billion buyback in 2025, the company just launched a brand new €500 million share buyback program specifically aimed at capital reduction. And they aren't wasting any time here. By early May, they had already executed 25% of it. That is a massive signal of confidence from management in their own newly transformed business.
Add to that a highly attractive, stable dividend of €2.50 per ordinary share. Management has been explicitly clear that they are adopting a stable to preferably rising dividend policy going forward. They're clearly committed to generating sustainable value and returning it directly into the hands of investors.
Now here's where it gets really clever. There's a unique tax mechanic at play with this dividend. Due to Swiss tax laws, this €2.50 payout is actually split. 65.6% of it comes from capital contribution reserves, which means it gets paid out without any deduction of Swiss withholding tax. It is a highly efficient way to return capital. All of this capital action created a remarkably busy timeline for the corporation in May of 2026. You had the annual general meeting on the 7th, the ex-dividend date on the 11th, the actual payout on the 19th, but it all culminated in a major structural and strategic move on May 21st.
a dual listing of their ordinary shares on the SIX Swiss exchange.
This dual listing alongside Euronext Amsterdam is definitely not just symbolic. It's a calculated maneuver to broaden their access to Swiss and international equity investors. It firmly anchors their dual Swiss-Dutch heritage. Remember, Firmenich was historically a Swiss fragrance house, and it allows for inclusion in highly relevant Swiss equity indices, which is huge because that drives passive investment flows.
Before we completely wrap up, let's take a quick look at their 2026 outlook. They have officially reaffirmed their full-year guidance. They're projecting 2 to 4% organic sales growth, an adjusted EBITDA margin hovering around 20%, and a cash conversion rate of 11 to 12%. They're expecting a gradual margin improvement throughout the year as cost impacts get passed on. However, they do note a caveat. This outlook relies on geopolitical headwinds, specifically the conflict in the Middle East remaining limited in the second half of the year, because escalations there could obviously impact freight and energy costs.
So they've shed the dead weight and posted a stellar Q1, but the real test is just beginning. Can this newly minted, pure-play consumer giant navigate a volatile geopolitical landscape and defend those premium margins? And maybe more importantly, is this the blueprint that other bloated legacy corporations are going to have to follow to survive the rest of the decade? Thanks for joining me for this explainer. Keep your eyes on the data.